Hi guys, good morning and welcome to Power Breakfast. I'm Pavitra Parekh. Those were all of the top headlines that we're tracking for you this morning. So clearly we have a lot to get to and we'll talk about all of those individual stories in just a bit. But first up, let's take a quick look at what's happening as far as the global markets go. We did get that weak handover from Wall Street. Once again, US futures are in the red this morning. And on the back of that, you have all of the Asian markets reflecting those losses. Mind you, a lot of the Asian markets are shut today. So Japan, Taiwan, as well as the Korean markets are shut, but we do have rates from Hang Seng on your screen, and you're seeing a sharp cut, over 2% gone on the Hong Kong markets. You also have Shanghai and Straits, which are trading, so those ones are seeing some cuts as well. Straits is down around 0.9%, while the Shanghai markets are seeing some minor cuts right now. So that's what's going down across the Asian markets. Clearly quite a weak start. The SGX Nifty will also come up for you, and it is indicating a weak start, a gap down opening for our own markets. We currently have a 260-point downtick on the SGX Nifty. So that's what's happening across the Asian markets. We're going to keep tracking this, but in the meantime, here is a word coming in from Hugh Young of Aberdeen. So let's listen in to what he has to say on the Asian markets.
There's risk in Asia, but of all the regions, I would say there's probably the least risk. But we've seen major risk in certain countries, Sri Lanka, of course, being the prime example of very high risk. So there are those areas of concern, but fundamentally looking around Southeast Asia, not huge areas of concern. But yes, whatever happens in the US is going to have a major impact globally, and it's hard to be bullish on many macroeconomic factors.
All right, that is an important word coming in from Hugh Young of Aberdeen. But with that, let's also move on and talk about the U.S. markets now. So Wall Street ended Friday's trading session sharply lower. The Dow Jones slid over 600 points after the jobs report. The S&P 500 was down 2.5%, and the Nasdaq Composite closed with cuts of over 3.5%. CNBC's Sarah Eisen is here to bring us up to speed with all of that action from Wall Street.
Here on Wall Street, stocks ended the week with substantial losses. A decline in the nation's unemployment rate reinforced fears that the Fed will have to keep aggressively raising interest rates to bring inflation under control, even if that means the economy goes into a recession. But today's drops didn't entirely erase the strong rally we saw earlier in the week. The Dow ended the day down more than 600 points, more than 2%, although it still managed a 2% gain for the week. The S&P 500 closed almost 3% lower on the day, but still up 1.5% overall for the week. And then there's the Nasdaq, which ended down almost 4% today, got hit hard, still up less than 1% this week. The supply chain problems that have limited auto production, they're finally starting to ease, getting more new cars onto dealer lots. But even as supply is increasing, demand is falling because the Fed's rate hikes are making loans to buy those cars much more expensive. That's the action from the U.S. market. Back to you in Mumbai.
All right, clearly a hectic day of trade in the U.S. markets. All of that showing up in the Asian markets as well, like we've been talking about. But let's stick with the U.S. and also bring you the all-important jobs data that came through. Non-farm payrolls increased by 263,000 for the month of September. And the unemployment rate also fell, and it's currently at around 3.5%. CNBC's Steve Leisman filed this report.
Here's the data, gave you the top line number, 263, 275 was the estimate. So in and around there, not much really to worry the markets. There was the revisions were up 11,000. Average hourly earnings still strong, 0.3%, 5% year over year. It was the unemployment rate, I think, that spooked the market most, 3.5% versus an estimate of 3.7, down from 3.7 was the estimate. And the labor force participation at 62.3. Ticking down, workers not coming back to the labor force. Let's take a look at where the jobs were or are. Leisure and hospitality, 83,000. Healthcare, 60,000. Those are two places where they're still running below pandemic levels. Professional business services, 46. Manufacturing, clocking in pretty good at 22,000. And local government education, teachers come back in September. Could be some seasonal adjustment there, down 22,000. The market may be taking this maybe a bit harder than warranted. A bunch of the job growth, as I was talking about, coming in industries that are still running below their pre-pandemic employment level. For example, leisure and hospitality is down 1.1 million workers compared to the pre-pandemic level. And the headline payroll number, well, it's down for the second straight month to the lowest job gains since April of 2021. Still, the effect of it all was to boost the expectation for Fed rate hikes. Futures markets see the year-end Fed funds rate at 4.36. That's up this morning. And the peak rate in April 2023 at 4.65. That is also up. Even if there are hints of a slowing, a chorus of Fed speakers yesterday made clear they're not looking for subtle evidence of inflation declining. They want clear and convincing evidence over many months. Today's job number does not rise to that occasion.
All right, Steve, thanks a lot for getting us all of that action as far as the jobs market report goes. But with that, let's move on and bring you the final update of our global market wrap. European markets also ended the week on the back foot. So the French CAC index lost over 1%. The German DAX was down around 1.5%. And the British FTSE index closed quite flat with losses of just around 6 points, like you can see on your screen. Now, shares of Credit Suisse closed with gains of over 5%. This after the bank offered to buy back up to 3 billion Swiss francs of debt securities. The Swiss lender also confirmed that it is selling its famous Savoy Hotel in Zurich, prompting some speculation that it could be scrambling for liquidity. Remember, shares of Credit Suisse had hit an all-time low last week after credit default swaps reached a record high. So this is, of course, a developing story, and we're going to keep bringing you updates on it. That's everything that we're tracking globally.